So here's 930. That opening price here. At 930, what's actually happening is the equities are opening up. The stock market starts trading. That's when you hear the bell, ding, ding, ding. All of a sudden, everybody's clapping their hands on TV, whatever. That's what's occurring here. It's opening. So it's running a short-term high right here, and then breaks lower. Creates an imbalance here. So on the 15-minute time frame, what do we see? Did it take a high out? Yes. Did it break below low? Yes. Was there displacement? Yes, it was energetic. Did we trade back up into it here? Yes. So in here, you could be a seller and get in sync with the run to try to get positioned for, if you are a swing trader or short-term trader, this could be your entry, and then aim for that old relative equal low, which is that blue line here. Remember the two equal lows on the daily chart? I drew a line on. That's what this is here. Okay, and it ran down into it today. At 8:30, right there, we're using the opening price. Did price trade above it? Yes, it's in a premium. It's above an old high. That makes it a premium too. I believe it was a young lady, and I apologize, I don't recall, and I didn't make a note of your name, so please don't be offended, but I know I saw it where it was saying something to the effect that you don't understand how it could be in a premium because it's above an old high. Anytime the market trades above an old high, that is a short-term premium because it's going into liquidity. Anytime the market trades below an old low, that's a discount. Okay. Now, just like the purposes of what people use overbought, oversold indicators, things can be overbought and still go higher. Things can be oversold or in a discount and keep going lower. Okay. See, that's why I'm suggesting that when people are studying price, they can't just assume that an indicator is overbought, so therefore it's a good sell or a shorting opportunity. It's not always. But if you understand the narrative within market structure is not the answer. It helps you frame an idea, but the idea must be in alignment with the present narrative. Narrative is why should the market go where you think it's going to go on that particular day, based on the climate, the economic calendar events, and the volatility that's being offered for that particular trading session or day. So these are all things that you're going to need to study, and I teach on this YouTube channel. And I'll teach a little bit more when we're doing the live sessions because it'll be more practical then. So that way you're over my shoulder, you're looking at it just like I'm looking at it, and I'll give you my internal dialogue and kind of like what I'm thinking that is the most salient at the moment. So that way your attention is on the right things at the right time. But power 3, which is the open, rally up or manipulation, creating a high, and then the movement lower, and then distribute their shorts below an area where there would be stops. So smart money would be selling short the buy stops here, riding this out, and then offloading their shorts to sell stops below those relative equal lows. Remember, when we see those relative equal lows on the daily chart, traders are going to look at that as a breakout. There's lots of traders out there that have long-term trend following systems and models, and if it breaks below those areas, they want to be short. So that's going to flood the market with what? Market orders to sell at the market. Well, that's a perfect counterpart to smart money being short up here because they want to buy it at a lower price. And while up here, they're aiming down here. Is it hard to believe that when we were already outlining that last week and the week before? No. We have visibility. We have the ability to forecast certain things that should repeat. If the algorithm is in fact in control and we understand what the algorithm is doing, and I'm suggesting that my experience should indicate that we have that, does it deliver? Here it is. Okay, so you're taking the logic of certain principles and concepts and blending them with market structure. We're looking for lower prices, and it should reach for a specific low. But also, how does the present narrative allow for engagement with the daily range or power 3? Everything I've taught you. So it's the open rally. Smart money enters near the high today above the opening, and they get out down here at an important low, and the market closes near the low of the day. Let's go into a 5-minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this off here because it's no longer useful. If you're looking at that like that, here's the opening price. You know that there's what resting above that? Buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that out. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least, okay? Market punches up through. Yes, it does take those out. Then it breaks down, comes one more time back above the opening price, and then gives up the ghost and aggressively runs for the sell side below here. Now, for some of you, that would be enough. Getting short up here, buying it back below the lows, and being done and walking away. There's nothing wrong with that if that's your model. But we're going to take a closer look inside of this area here and see what we see. All right, let's drop down into, I'm just going to go right to the 1-minute chart just to save time. All right, so we have in this area where the market ran above those relative equal highs. Here they are here. The market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was there displacement? Yes. Does it market come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you may have a little bit of a drawdown, but your stop loss, if you're entering in this fair value gap, your stop has to be above the very minimum, the candle that creates the fair value gap, that's here. So your stop's got to be above that. For good measure, conservative, up here. Oh, but ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely, or are you just concerned about making the maximum amount of money on your trade? Dismissing the level of risk. That's what gamblers do. I'm not trying to teach gambling. So when you practice on your demo account, keep that in mind. That way you're not trying to overextend yourself. The sell side below these lows in here, after it hits the fair value gap here, and then one more time into it, above the opening price, it breaks lower and aggressively runs below here.